love the channel and find it useful in becoming a happy retiree. Subscribe today. Sandy joins us from Decula. Sandy, what's going on? How can I help?
Hey, how are you doing this morning?
Good.
I was listening earlier to an earlier call, and you caught my attention when you were talking about the minimum required distribution for Roth, or for regular IRAs or 401s or 403s. You said the exception. You didn't say exception, but you said except Roth IRAs. And I'm like, what do you mean except Roth IRAs? So I looked it up, and it said I do not have to worry about a minimum distribution until my death. So now I need to know what that is all about.
Okay, so this is interesting. With one of the back when Roth IRAs were new, and we were jumping up and down about how great they were, we were saying really two things. We were saying that you can put money in these, you don't get a tax deduction for it like you did with a regular IRA or a pre-tax contribution like you would at a 401k. But the money grows tax deferred and it comes out tax free when you use it. You put in $500,000, it grows to, or you could put in $50,000, it grows to $500,000. Every dollar you take out of that Roth IRA comes out tax free to you, which is great, right? Different than an IRA. You pull money out of an IRA, it comes out as ordinary income. So what we were always jumping up and down about, and quite frankly still today, is that that's one of the great things about the Roth, the tax-free status. The second thing that's not quite nothing's as good as tax-free, the second bell or whistle on a Roth account rule that's in your advantage is that you do not have to take a required minimum distribution from it. And that's helpful if you get in your 70s and you don't necessarily need money right now. The IRS forces you to take it out of your regular IRAs, upping your tax bracket, upping what you pay to the IRS. If hypothetically all your money was in a Roth, then you wouldn't have to worry about doing this required minimum distribution. So most folks will have some money in a regular IRA, and I bet you this is your case, Sandy. Correct me if I'm wrong. I bet you have some IRA money and some Roth money. And if that's the case, you still have to do your required minimum distributions out of the regular IRA, but you can exclude the value of the Roth in that equation, and you can exclude having to worry about taking a required minimum distribution as long as you're living. Does that make sense?
Right. Yeah, that makes sense.
What's a little weird about this, and you mentioned upon death, what's a little weird about this is that when someone inherits the Roth from you, they actually do have to take required minimum distributions. That's what makes it a little bit confusing. But in your case, Sandy, you do not have to worry about it.
Okay. And one other question I have on this. I have been converting some of my regular IRA money into Roth, and I'm wondering when I can, I'm no longer able to do that, or if I should even be talking with my advisor about what is my best game plan,
Sandy,
now,
you should be
10 years and down the road.
You're a better radio host than I am, because I should have brought that up too. This is another thought, is that if you can convert money from an IRA to a Roth, and that helps you in the future avoid these required minimum distributions. I have a scenario I'm working with a family today where they sold a property and they have a ordinary income loss because of the nature of the real estate transaction. So let's say you bank a $100,000 ordinary income loss from the sale of a property somewhere, right? Or you could take that ordinary income loss of $100,000, take $100,000 out of a regular IRA and convert it into a Roth IRA, and effectively cancel out any ordinary income taxes you would have to pay, because you take the loss against the IRA withdrawal that would otherwise be taxed, get that money into a Roth. So if you have some ordinary income losses in a year, then typically what families I see do, and this makes a lot of sense if this scenario comes up, is you can convert a pretty big chunk of whatever that ordinary income loss is. You can look at your regular IRAs and say, hey, I've got this big loss. Why don't I at least use it to convert money from an IRA to a Roth? That way, I don't have to take required minimum distributions out of this Roth account. So very good point. Again, yes, talk to your advisor about it. and talk to your CPA about it, because you really need to run a dummy tax return or a hypothetical tax return as if you were going to do that, to really make sure see how it impacts all of your other tax bracket, all of the other, your Medicare costs or your Medicare supplemental costs that can be impacted by it, or Part B. So make sure you're looking at all these scenarios when you're thinking about doing these conversions. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.